As the rally continued, equal-weighted S&P 500 also just hit an all-time high yesterday. Has anything changed since last 2 weeks ago? Little mini crisis? Is something different, or are we right back to where we were?
Not much changed, Dani, during the market meltdown. We saw a labor market come out a little softer, and not much has changed since the market rebounded and really melted up since then. What has changed? Nothing. So I think that tells us a couple things. One, the markets are highly levered to whatever economic data comes out. So we're all attuned to every ECO, high frequency data, that comes out at 8:30 or at 10 o'clock. And I think that's important for the markets to take into consideration, that volatility is pervasive and it's going to remain. And volatility isn't just to the downside, it's also to the upside. So I think it makes sense in times of market surging to protect those positions. That's something I've been saying for an extended period of time. And I think it makes sense now when the VIX has collapsed back down to sub 15. Going into the end of the year, we see a lot of events that could be moving the markets, including elections and ECO data. And I really think that that gold is going to continue to perform very well. I still like equally weighted S&P. It's been one of my top performing calls this year. But I do think it makes sense to put on protective hedges.
Kathryn, just on that note, good morning to you. Yeah, you're right. Gold's had a cracking run, 2,500. I knew that trade would come good one day. Long time ago.
That gold under your bed, Manus?
Stacked under the bed. That's why the bed is raised up. On a slightly more serious note, we've got 10-year government bond yields at 3.87 this morning. And this is what Dani and I were chatting about, is the equity market is flying higher. There's the elixir of life in the equity market of a soft landing and margins and earnings that are supportive. But the bond market is telling us something different at 387. It's sub 4%. The bond market is more worried about the landing than the equity market, isn't it?
Well, that's exactly the case. And the truth is, when you look at the past 7 episodes over the recent decades, when the Fed does start to cut rates, that's when the rubber hits the road. That's when we see how the strength of the economy is. In this ensuing 12 months after the first Fed cut, 43%, according to our StoneX estimates, of those 7 episodes over monetary policy history, we've seen recession ensue. That's not a small percentage. So I do think that that investors should be contemplating the possibility that we could see a rollover in the U.S. economy. And I think the risks are underestimated currently in the equity markets. And the bond markets, I think, are taking that more into consideration. So look, the S&P, for example, if you look at the past 7 episodes that I talk about in monetary policy history, if we don't enter a recession, the S&P rockets on average 19% higher. But if we do enter a recession, of course, we're talking double-digit debt to the downside. So the message that I have is to be prepared for that ensuing volatility. Don't assume that the current trend is going to be semi-permanent in nature. The Fed is likely to cut, I think, 25 basis points in September, and then go on a quarterly pace at 25 basis points. Likely, the terminal rate is going to be a lot higher than what the markets are anticipating if we don't go into recession. I think that's the only way the Fed really can attempt to hit that 2% target.
What about sort of the other risk, not necessarily recession, but that the economy is strong and they don't cut 25 basis points consecutively for the next meetings? Kathryn, how much is your equity call, your more bullish equity call, contingent on continuation of cuts from the Fed?
Well, I think it's contingent on economic growth. I mean, we saw this last year. The markets are anticipating a lot of Fed cuts, and it didn't happen, of course. But it didn't matter because the economy grew very, very robustly, and it continues to grow robustly. So I think there's a bipolar fat tail risk in nature here, Dani, and you make a good point. I think you could see an overheating of the economy, and effectively that's kind of where we're at. I mean, potential growth in the U.S. is 1.8%. We're growing at 2.8%, so that's inherently inflationary. We have an output gap that's positive, inherently inflationary. So I do think that we're unlikely to hit the 2% target without recession. So really, I think that we're going to see inflation sticky above 2%, probably 2.5% without recession. And the Fed only cuts one time, 25 basis points per quarter over the course of 2025. So we get about 125 basis points in total Fed cuts, in my view, in this cycle.